Very recently, there is a shift in focus towards PSUs, that is public sector undertaking companies, as many people across India discuss about the same. There are a lot of questions pondering in mind as what are PSUs, why there are so much talk about PSUs and what does it offer. Let's discuss this in this video. Our Prime Minister, Mr. Narendra Modi, recently said in the Parliament that one has to consider investing in PSU companies, that is, public sector undertaking companies. He said PSUs are delivering robust numbers and are competing with peers. He cited examples of few companies, and hence people believe it's time to accumulate PSU stocks for wealth creation. Also, the media has gone with plenty of buzz with this news. PSUs in India are government owned companies with a minimum of 51% stake held by the government. They play a crucial role in driving economic growth and focus on sectors like coal, finance, power, infrastructure, and more. Their aim is to develop and expand the country's infrastructure and laying a strong foundation for progress. If we see the PSU stocks, they are not the growth stocks, which means they are very cyclical in nature, meaning these stocks trade in a zone which is very volatile, and hence these are normally considered as trading stocks and not the investment stocks. To invest in public sector undertaking companies or not has remained a $1 million question for investors due to its volatility in nature and making this a tough decision to decide. So, how do we resolve this dilemma? We will look at its data and its facts. Now, let's glance through the following table. It displays the returns generated by a few PSUs in the last 5 and 10-year periods. All the returns are compounded annually. If you look at the company like Coal India, despite being a monopoly, its 5 years annualized return is at minus 21.98%. However, its 10 years annualized return is at minus 15.83%. Company like NMDC, being India's largest iron ore producer, its 5 years annualized return is at 11.3% and its 10 years annualized return is at minus 1.24%. New India Assurance, being largest nationalized insurance company of India, its 5 years annualized return is at minus 47%, while its 10 years annualized return is at minus 63%. Similarly, if you look at companies like NHPC, Punjab National Bank, Union Bank, India Tourism Development, General Insurance Corporation, Indian Oil, ONGC, BHEL, all these PSUs last 5 and 10 years annualized returns are negative. PSUs are known for lagging in operational and financial performance because of its years of high disinvestment and bureaucracy, which led to the downfall of these stocks even when other overall markets were rising. Having discussed about the nature of PSU stocks and their performance, there are still a few hidden gems which are really doing consistently well and which could grow over a period of time. These are good quality fundamental stocks with sound financials worth considered to be investing for long term. Curious about these stocks? Let's discuss deep to know its fundamentals, scope, and its competitive advantages. The first company is State Bank of India. It is India's oldest and largest bank in terms of business and assets. SBI is counted as one of the top PSUs in India, which is headquartered in India's financial capital, Mumbai. Presently, the Government of India holds 57.47% stake and it is one of the Fortune 500 companies. The consolidated total income of the lender grew from rupees 3,30,687 crore in FY19 to rupees 4,73,378 crore in FY23. The net profit during this period soared from rupees 3,085 crore to rupees 56,558 crore. The bank's dividend yield is at 1.9. SBI has a robust record of growth in corporate credit and retail banking. There is no doubt that this bank of the nation holds a dominant position in the sector of banking and finance. It is the largest bank in terms of its size. If you look at the branch network, presently the bank operates a network of 22,219 branches and 62,617 ATMs across India. It also operates 71,968 business correspondent outlets across India. The bank has a market share of 22.84% in deposits and 19.69% share in advances in India. Also, it has a strong customer base of approximately 45 crore customers. The retail loans account for 39% of the loan book, followed by corporate with 37%, small medium enterprises with 14%, and agriculture with 10%. In terms of retail book, home loan accounts for 68% of retail book, followed by express credit with 22%, auto loans with 9%, personal gold loans of 22%, and others with 9%. The bank has a global footprint with a network of 233 branches in 32 countries. It has a presence in USA, Canada, Brazil, Russia, Germany, and other countries. So SBI has always been the banker of choice to the government of India, and it is a market leader in government business. Apart from national reach, SBI has customer touchpoints across the world with international presence at 29 countries with 235 offices. The financials of this bank is looking very solid as it has given consistent value to its shareholders. If you look at its market capitalization, it has increased from the levels of 2,86,257 crores in FY19 to the levels of 5,23,250 crores in FY23. Its share price has zoomed a lot from the levels of 320 rupees in FY19 to the levels of 586 rupees in FY23. Good to see that it has given a good dividend per share, which has been increasing year on year. Earnings per share also increasing, which is a good sign for the company. Book value per share is also in a good uptrend. Also, the performance of CASA, that is current accounts and savings account, express credit, return on assets, term deposits, home loan, return on equity, all showing a good decent uptrend. The bank is holding a leadership position across all segments on retail personal banking, with retail personal portfolio of 12 lakh crore rupees, and its 3 years CAGR is at 17%. And if we look at the home loans, year on year growth is at 13.47% with 0.76% on GNPA. Auto loans 22.97% year on year growth with 0.7% of gross NPA. Express credit with 19.75%, personal gold loans with 19.29%, and other segment loans with 19.21%. Overall, it is showing good recovery and good performance. Overall, apart from good financials, the company is holding good credit growth followed by asset quality, well provided stress book, and good digital strategy. The bank started its journey during Jan 1999 with a price band of 15 rupees and presently it is trading at 571 rupees with an overall return percentage of 3684%, which is phenomenal and this continues to grow. Next company is Hindustan Aeronautics Limited. Company is engaged in the business of manufacture of aircraft, helicopters and repair, as well as maintenance of aircrafts and helicopters. It is a core aviation equipment supplier for the country, with India's defense program being the only Indian company having a specialization in aircraft manufacturing and providing its maintenance and related services. The company is highly dependent on contracts from Ministry of Defense. Its export revenues are approximately 1% of the total revenue. The company spends approximately 6% to 7% of the total revenue into research and development activity annually. As of August 23, the order book of the company stands at 86,000 crores. The company has signed an MOU with Safran to set up a joint venture intended for development, production, sales and support of helicopter engines and signed an MOU with the IAI, Israel Aerospace Industries. HAL and Zero Avia entered into a development collaboration agreement with Hydrogen Electric. The company has a healthy cash reserves and strong balance sheet. Government of India's Make in India initiative works very well for this company as this creates to develop, manufacture and assemble products made in India and incentivize dedicated investments into manufacturing. Other good news is government has allocated more funds in defense projects to increase supply of aircrafts and helicopters, which eventually increases the profitability of the company. Overall, the company is having a very strong order book on manufacturing contracts, repair and overhaul, spares, design and development project and exports. If you look at the financial performance of HAL, the revenue from operations has increased from the levels of 20,008 crores in FY19 to the levels of 26,928 crores in FY 2023, with a consolidated year-on-year growth of 9.37%. The activity-wise revenue from operations looks very solid. Hence, we can see that from manufacturing, development, and exports, all these areas seeing a significant development year on year. Further, from revenue from operations, it is increasing year on year, quarterly as well as annually, which is a very good sign for the company. If you look at the EBITDA and EBITDA margin, both are in an increasing trend and it keeps increasing year on year. Also, there is a consistent year-on-year performance on PAT, that is profit after tax and its margins, along with earnings per share. Presently, the share price of HAL is trading at the levels of 3,787 rupees from the levels of 1,132 rupees, with overall return percentage of 234, which is very good. Though the share price is very expensive, it is undervalued as the stock PE is less than the industry PE. This is a monopoly company and hence we can see good consistent performance year on year, especially when government is pumping lot of money on defense projects. Next company is Indian Railway Catering and Tourism Corporation Limited, otherwise called as IRCTC. Incorporated in 1999, IRCTC is authorized by the Indian government to provide online railway tickets, catering services and packaged drinking water at railway stations and trains in India. Following are the key services offered by the company. Mobile catering. It provides catering services to as much as pantry cars along with train side vending services for trains that do not have pantry cars. Orders are taken from passengers and meals are picked up from specified pickup points. Static catering. Companies operating food plazas, fast food units, Jan Ahar and cell kitchens to provide economy meals to passengers. IRCTC has refreshment rooms for ready to eat and thali meals. The next is hospitality services. IRCTC has executive lounges, retiring rooms, and Rail Yatri Niwas equipped with Wi-Fi services, buffet meals, and washroom services at affordable prices. E-catering. Available at 200 plus railway stations. E-catering is a new service where passengers can order food from partnered restaurants that will be delivered to their respective seats. Packaged drinking water. With as many as manufacturing plants, the company is producing 23.83 crore units of fully automated water bottles with 42% of capacity utilization, followed by internet ticketing. Company is the only authority that is permitted to offer online ticket booking services for Indian Railways through their mobile application and website. On an average, 11.4 lakh tickets are booked per day. It has also developed e-ticketing applications for paramilitary forces and border security forces for booking reserved rail e-tickets for their personnel and introduced a chatbot Disha for customers to buy tickets through a chatbot using voice and chat. Finally, tourism. The company also has a presence in tourism, which offers tourism packages, air packages, city tours, luxury train packages, etc. under its tourism verticals. Company also signed up an agreement with Cordelia Cruise for promotion and marketing of their first luxurious cruise liner in India. Some of the growth factors of IRCTC are increased investment in railways by 27.5% in the present union budget, 400 plus Vande Bharat trains to be introduced in coming years, growth prospects in tourism and travel sector including religious and pilgrimage tourism, and digitalization of payment system. The market capitalization as on March 31, 2023 is at 45,840 crore. Its 5 years CAGR in revenue is at 19.21%, while its EBITDA margins has increased to 38.14%. Also, approximately there are 61.24 lakhs daily logins are happening on IRCTC app. Further, its 5 years CAGR in profit after tax is at 35.59%. So overall parameters looks very good for the company. If you look at the financial performance of IRCTC, its net worth has increased from the levels of 1071 crores in FY19 to the levels of 2478 crores in FY23, with a jump of 32.5%. Its EBITDA has increased from the levels of 472 crores in FY19 to the levels of 1396 crores in FY 2023 with a jump of 47.1%. Its revenue also increased from 1870 crores in FY19 to the levels of 3541 crores in FY 2023 with a massive jump of 88.5%. If you look at PAT, that is profit after tax, there is an increase in performance from 308 crores in FY19 to the levels of 1005 crores in FY 2023 with a jump of 52.5%. The company is available at attractive price for the shareholders as presently it is trading at the levels of 642 rupees with overall return percentage of 312. Another PSU company worth considering for long-term investment is Mazagon Dock Shipbuilders Limited. The company is primarily engaged in building and repairing of ships, submarines, and various types of vessels, and related engineering products for various domestic and international clients. The company is a leading player in shipbuilding industry of India, which manufactures warships, advanced destroyers, missile boats, and submarines for defense sector. The company earned approximately 89% of its revenues from ship constructions, followed by sale of base and depot spares of 8% and 3% on ship repair. The company's dockyard is located in Mumbai, which is also headquarters for Western Naval Command of Indian Navy. They have a future plans of graving dry dock and greenfield shipyard at Neva. The company is looking forward to diversify its activities and increase presence in the field of underwater equipment and platform, marine equipment and platform, heavy engineering equipment and offshore platform, etc. The company holds approximately 47% stake in Goa Shipyard Limited, which is a leading shipyard of the west coast of India. Following are the infrastructure for shipbuilding and submarine division. The company has a strong order book on shipbuilding, submarine and heavy engineering. Healthy order book provides execution stability and consistent cash availability. The product lines for naval platforms are destroyers, conventional submarines, frigates, corvettes, missile boats, etc. For merchant ships, the product lines are general cargo vessel, multi-purpose support vessel, offshore supply vessel, tugs, dredgers, etc. For oil sector, the product lines are offshore platforms, jackup rigs. The journey of the company is very significant as it has incorporated as a private company in the year 1934, and from there on, the growth of the company has increased leaps and bounds. The data shows financial performance of the company where its revenue from operations has increased from the levels of 4048 crores in FY21 to the levels of 7827 crores in FY23. Also, its profit before tax seeing a good uptrend from 730 crores in FY21 to the levels of 1403 crores in FY23. Similarly, its EBITDA margins has increased from 798 crores in FY21 to the levels of 1485 crores in FY23. Good to see that the net worth also seeing good positive flow from 3432 crores in FY21 to the levels of 4760 crores in FY23, followed by profit after tax seeing a good uptrend from 514 crores in FY21 to the levels of 1119 crores in FY23. The company started its IPO during October 2020 with a price band of 168 rupees and presently it is trading at the levels of 1869 rupees with overall return percentage of whopping 1112%. So these are some of the handpicked PSU stocks which are worth considering for long-term investment. If you have any other potential PSU stocks in mind, do mention the same in the comments box. Also, if you like the content of this video, please do like, share it with your friends and family, and do subscribe for more such interesting videos. Jai Hind.